gives me great pleasure to bring on board Mr. Russell Napier to talk about his views on world, the economic impact of the war, how exactly is the world prepared for a higher interest rate regime, and what does it mean for emerging markets like India. Now, Mr. Napier is a financial historian. He's got years and years of understanding of how cycles work. His call on inflation in middle of pandemic certainly set cats among the pigeon when he said that world should be ready for not a structural uptick in inflation, but for a bigger problem coming soon. And inflation now is perhaps become the biggest public enemy #1 after COVID. Mr. Napier, fantastic to have you back on ET now. It's an extraordinary pleasure. We're very grateful that you managed to find some time.
Well, thank you very much for inviting me.
Mr. Napier, let me just start with the headline which has grabbed a lot of attention earlier this week, which is the US bond yield inverted and we should now prepare for a recession. For a world which was hungry for inflation couple of months ago, now we are talking about recession coming soon, sir.
Yeah, I don't believe that. I know that this has a rather good historical record at forecasting recession, so I'm aware of the history of the indicator. But it has also been wrong, and it can be wrong, particularly if we change the nature of the system. So this has really been that call that I've made since May 2020. It wasn't just that inflation was going up, is that the nature of the system was changing, and it was becoming a less market-orientated system and a system more driven by government intervention. It's been obvious in the bond markets for many years. That was central bank intervention obviously played a huge role in shaping yield curves, spectacularly so in Japan as we speak, but also in the United States of America. And I would ask those who are taking their measures of future economic activity for the bond market to think back to May 2000 and tell us what the bond yield was getting right about the outlook for growth and inflation. And even if it was getting it right in the direction, was it anywhere close to getting it right in the magnitude? Now, there are two elements to the manipulation of bond prices, and one is that central bank intervention, but the second is a growing financial repression, forcing financial institutions to buy these bonds. And it's at a relatively small level at the minute, but there are certainly US institutions, particularly in the life insurance industry, that find themselves having to buy the bonds. So it's almost the last refuge of the scoundrel to say, here's a market price that isn't a market price. It's an easy way to dismiss anything, to say it's ceased to have these values, but that is the call. It's a structural change in how the system works, and that pricing is falling more into the hands of the government, and it's less reliable as an indicator of what the future will be. So basically, I do not see there being a recession. I think there's going to be a huge capital expenditure boom across the developed world. Consumption, yes, the tax of higher energy hits consumption, and particularly the poorer section of society, wherever they may be, anywhere in the world. But there is a large chunk of developed world society in particular whose balance sheets are in pretty good nick following COVID and underconsumption. So yes, there is a tax, but it won't be as bad, the energy tax, as we think on consumption. And I think what the world really doesn't get yet is the scale of the capital expenditure boom that's coming, particularly as we reinvest in a huge scale to reduce our reliance on China, not on Russia.
So what do you think are the ingredients in the melting pot which will influence the economy? Is it price action by the central bankers? Will it be about national security and geopolitical prices, or it could be once again about good old energy shock?
Yeah, I think the key speech now was day before yesterday by Lindner, the politician in Germany, who very clearly said that China ideologically is the enemy of the developed world. Now, that's coming from the Germans. That's a huge thing, because we had a similar speech to that by Mike Pence in October 2018. But this speech was almost identical. And of course, the crucial thing is, what is he going to do about it? And he made it clear, as President Macron has made clear before him, that this is state-directed investment is what we get now. Now, we've lived through a 30-year period, and India since 1991 has backed away from a system where the state allocates resources to drive growth. But we are straight back in that. Now, this was going to happen anyway. But the war has made it even starker about the over-reliance that the developed world has upon China. I emphasize that again, not Russia. If we were just investing to become less reliant on Russia, there would be an energy transition. Now, there will be an energy transition. But the speech by Lindner was very clear that we also need to prepare for this with China. So that's the nature of the new economy. And it's a capital expenditure boom with a lot of government interference to send that to places it would like it to go. Now, I characterize those places as old industry, the industries that have really suffered from Chinese competition for 30 years. And one thinks of steel, petrochemicals, shipbuilding, all getting massive boosts of government money now. And that will be the great surprise. The great surprise for the developed world is either through private sector needs for capital expenditure or public sector demands for capital expenditure. This economic recovery will be strong with capex. And if you've been a developed world investor for the last 30 years, you've really not seen that before. There was a bit of a capex boom around fiber at the end of the last millennium. But on a whole, if I draw a line of a chart of capital expenditure as a percentage of GDP for the developed world, it's been slumping for, since China devalued the exchange rate in 1995. So we're going to see that going up. So the surprising thing will be the strength of the economic recovery, which will continue despite the energy tax, but also its nature to be very different from anything we've been used to in the developed world for the last 30 years. And you can be excited about that, and we need the growth, but behind it there's a government driving. It's a new industrial policy for the state. That's the words of Emmanuel Macron, the president of France, and we all know the history of those. They tend not to be very successful in the long run, but in the short run, they certainly create good growth. In the long run, they tend to produce a misallocation of capital. But Lindner's speech has lit the touch paper for a massive investment in Europe and also in America to reduce our reliance upon China.
Our viewers, Mr. Napier, would like to understand your thoughts on how exactly you think the Russia and Ukraine war will change the dynamics. There is a thought, which is a widely discussed thought now, that this is end of globalization in the world.
Yes, well, the end of globalization started roughly in 2011. There is a professor at the University of St. Gallen who tracks this protectionism. And in terms of the sort of most free trade we've ever had, that was in 2011. And it's been reversing since then. That is noticeable. That's even before the election of Donald Trump. So it's been underway for quite some time. So this has been an obvious trend now for many, many years. The war, as I've already discussed, clearly exacerbates that trend. We are heading into blocks again, and one block cannot afford to be reliant on the other. So I've focused on the investment boom in the developed world, but China also is trying to build lots of capacity, particularly in chips, where it is deficient. And everybody's preparing now for there to be two blocks that do not trade with each other, that capital does not flow between them. So this is about much more than America. So yes, the age of globalization has ended, but it ended some time ago. I mentioned the definitional speech by Mike Pence in October 2018, which was ignored by just about everybody as the sort of rantings of a madman about this ideological gap. So it really started to accelerate then. People thought the Biden administration would somehow reverse it. But they weren't reversing it, and they were trying to bring Europe on board with it. And the definitional thing about the war is it brings Europe on board. It focuses Europeans on their reliance upon Russia and China, and a reliance now which has to end. So the thing about this war is, yes, it accelerates it, but I think it makes it very clear to people who hoped that this was a US Republican drive, not a deep definitional change in what globalization is. And now it's absolutely clear that that's what it is. So the markets are finally starting to react to that. And my forecast for many years has been that the terminal value of foreigners' investments in China will be zero. Because in a full Cold War, which I think is now more obvious than ever, capital does not flow freely between two nations in a Cold War. And therefore, it will be difficult, if not impossible, to extract any current investments in China and turn them into US dollars or euros or any other currency in the world. So the war has just focused and exacerbated and sped up something that's really been around for over a decade.
Mr. Napier, so where does a commodity consumer like India fit in? Because in a commodity boom and a bust, sir, you've always mentioned that there's nothing like a bust. It's all about wealth which moves from a producer to a consumer in a commodity downturn, and the vice versa happens in a commodity boom.
Yeah, so there are different ways of looking at inflation, and I tend to believe that inflation is everywhere and at all times a monetary phenomenon. So I want to look at commodity prices in that context. The history of the 1970s is when we had high inflation is that these rises in prices of commodities were accommodated by the central bank and accommodated through higher money supply growth. And that was a political choice, and it may well even have been the correct political choice, because the consequence of not doing it was really a pretty steep decline in real economic activity. And they decided not to do that and to accommodate it. So I now look at India, and I look at the Reserve Bank of India, and it really stands out over the last 2 to 3 years. I mean, it stands out like a shining beacon of maybe what a central banker should be doing. Because if I look at the growth in broad money in India, it did have a little spike during COVID, but effectively it's been stable and it's come back down to where it was before. In other words, in the developed world, first from COVID, and now I expect also because of the war, central bankers have bent over and accommodated, and Indian central bank so far seems to be standing up against that. Now, you will know that, and I've just said that creates issues for the real economy. But it's still, in my opinion, if you're an investor, it's a positive thing to do. India will have to solve the problem of commodity prices, perhaps fiscally. And that's particularly true for the poor population of India who desperately need this. Now, that's not ideal, but it is essential that food and energy flows to people who need it. I mean, need it to survive. And so there'll be a fiscal answer to that. So I think the crucial thing for India is, what does the Reserve Bank of India do? If it continues with the existing policy, then I think maybe it does mean slower economic growth for India. But, and it's a very important but, the monetary policy of India will really shine out as being very different from the developed world. And it brings us back to this issue that really is the cause of the change of the structure. Does India need to inflate away its debts? No. Very simply, no, no, and no. It has a level of debt to GDP, which is perfectly manageable for an economy like India. It doesn't need to take these extreme actions of the developed world. And if it takes that choice, and just because you have a choice doesn't mean to say you take it. There are lots of politicians in the world who make the wrong choice, even though they have lots of choices. I'm arguing that the developed world really doesn't have very many choices anymore. It's kind of path dependent on its policy. But if India can avoid making those mistakes of aping the mistakes of the developed world in terms of financial repression, it will still have to cope with inflation, imported inflation. But the RBI policy should ensure that we don't generate huge levels of domestic inflation. And there is a positive from all of this for India. There is one positive from financial repression in the developed world for India, which would be significant capital inflows. The first rule of financial repression is get your money out of the country. And if that's going to be true for Japan, for the Eurozone, for the United Kingdom, and ultimately even for the United States, where's it going to go? And if the RBI can continue with a sound, stable monetary policy, and the government of India can avoid accelerating repression, there are some repressionary elements left from the license Raj. They've tended to linger, but they're been slowly dwindling. But as long as they stay where they are and don't go back up again, then I think India will attract a large amount of capital. So there are positives and negatives in all of this for India. But if the government plays its cards right, I think ultimately the positives will be more important. And then we have to weather the storm on the energy price. And of course, it's a very volatile price, and it can collapse just as easily as it can soar. And a lot of that will depend upon the decisions made in Saudi Arabia. And we forget that sometimes, but we may not have to live with high energy prices for much longer if a deal can be done with Saudi Arabia.
Mr. Napier, you're a financial historian, and you've seen financial history, you've analyzed financial history. History may not repeat itself, but it certainly rhymes. So if you look at the scenario right now, when was the table of the setting similar to what we are staring right now?
Yeah, I like to. So nothing is ever the same, but as you say, it's similar. So in terms of as an investor rather than an economist, I would prefer to look at the period from 1966 to 1982. Very precise. Why precisely those dates? Because that was a period when the S&P 500 had reached a high valuation, from memory, about 26 times cyclically adjusted PE in 1966. And by 1982, it ended up below 10 times cyclically adjusted PE. That's important because that was a very long bear market. There were some volatile bits in there, some great collapses, some great rallies as well. But it was a 16-year period when the valuation was coming down because inflation was going up. And that 16-year period was the battle to try to control inflation. And because it took so long, clearly most of those battles were lost. They weren't won until Volcker arrived in 78, and the market didn't bottom until 82 because Volcker had to put so much pain into the economy to finally win the war, having lost so many battles, that forced the stock market to a low level. So I think that is a reasonable period to look at. And why didn't we win the war against inflation earlier in the 1970s? Because people didn't have the political will to enforce the pain upon the economy. It was an economy at that stage at war, and that was a Vietnam War. It was a social policy called the Great Society, trying to reduce inequality. It was the oil shocks, which, had you attacked them with higher interest rates, would have given you even lower growth. And politically, we just weren't up for that. And I think that's the world that we're moving into, where these challenges, and I would just run through a list of the global emergencies that we now face. There is, and particularly for countries like India, still very much a public health emergency. There is now a national security emergency, particularly for Europe, but I would argue also in Asia. There is an emergency to diversify the developed world's production capacity or imports away from China and Russia. There is a climate emergency as well. There is an inequality emergency, which is really getting bad because of food and energy prices. Now, these are emergencies which are very, very, very important and justify very, very extreme actions. So in some ways, even more emergencies than we had in the 1970s. War was the 70s, high energy prices was the 70s, the failure of the Great Society project was the 70s. I think there are many, many similarities. The key difference to me would be that nominal interest rates cannot, as we've already discussed and as you rightly raised, cannot go to levels we saw in the 70s, which just means that other measures, other administrative measures, whether it's price controls or credit controls, will ultimately have to be used to try and contain this inflation. So the interesting thing for an investor is in the long battle to contain inflation, not really won until 1982, the valuation of equities came down. And the real return from equities, this is US equities, even with dividends reinvested, did not go up. But to me, the interesting thing is within the S&P 500, there were sections of that market that did go up. So value stocks did all right. You got a positive real return. Mid-cap stocks did better than large-cap stocks. Small-cap stocks did pretty well. It's an old stereotype, isn't it? But it's a stock picker's market. It's going to be incredibly difficult in the developed world anyway to make money just buying the index. But I think there is a stock picker's market here. Capital expenditure boom helps certain types of stocks. The lack of Chinese competition will help certain types of stocks. An investment in a greener economy will help certain types of stocks. So that's the period I would draw an analogy with. And the hopeful conclusion might be that there are bits of the equity universe where we can still get positive real returns, even over this long battle against inflation, which will be lost over and over and over again until we find a new Volcker. And I wouldn't forecast that to happen within 10 years. And it's much more likely, I think, to be near 15 years, because ultimately Volcker was able to succeed because we had destroyed debt, because the debt to GDP ratio had come down. He was able, still painful, but able to take rates to a level to combat inflation. We are at least 10 to 15 years away from a world where nominal rates could really be driven above inflation to combat inflation, because we've got too much debt in the system. So we're in that structure. So that's the period I pick. 66 to 82, a difficult period to preserve wealth, purchasing power of wealth, but not impossible.
Well, you beautifully articulated that aspect for us. So I'm just going to take the liberty of asking a last question. Don't want to extend my appointment beyond that with you. What are the chances, Mr. Napier, that the Fed will just get desperate for image management? They have been hopelessly behind the curve in calling the inflation scenario in 2021. What are the chances that they may just get desperate and like to stay ahead of the curve?
Well, I think we're already there. I mean, if you look at the dot plot and the forecast for of interest rates and the forecast for growth, what you see is the Fed is forecasting that interest rates will go up and growth won't come down. I mean, I think there's no better sign of, it's maybe self-delusion more than image management, and this is where we always are. We always get into a situation where the central bank thinks by raising interest rates but not slowing growth, it can control inflation. And whether they're doing this deliberately and putting that out into the public domain, or whether they genuinely believe it, I don't really know. But we're already in the jaw because they've already lost the war. So yeah, there'll be plenty more about this. Also, economists generally tend to believe that inflation expectations are very important. So as they used to say, it was a famous European politician whose name I've now forgotten, but he used to say, Jean-Claude, no, not Trichet. Anyway, he used to say, when things get really tough, you have to lie. And when you're trying to control inflation expectations, when that's so important, actually the psychology of the people is very important. You must at all costs stop a rise in the velocity of money. So I think we're already in the jaw from all the central bankers, and actually the Fed is not the worst by any stretch of the imagination. The European Central Bank and the Bank of Japan are much worse. That jaw has already begun. But as time progresses, people realize that jaw is not enough. And at some stage, they will lose control of the velocity of money. And that's when they're going to have a real problem with inflation. So what is this new system I'm talking about? It's a system where the governments, through direct intervention, using carrots and sticks, control the growth of bank credit and control the growth of money. And therefore, if the governments can do that, the question, because monetary policy is controlling the quantity of money, not the price of money. The question for the central bankers who only control the price, where the government controls the quantity, the question is, what are you going to do all day?
Well, Mr. Napier, really appreciate your time, and we know that you're a busy man reading and analyzing the whole day, so I'm not going to stretch my appointment beyond a point. So really appreciate your time, and we look forward to host you very soon at our office on your next trip to India.
Well, thank you very much. And all I can say to everybody watching is good luck.
Thank you very much. Really appreciate that.
Thank you.